There's a lot happening on the geopolitical landscape which could have direct implications for the direction of the global economy. And jitters have manifested themselves today in global markets as we saw big sell-offs today. Well, to take us through some of his observations on global economies and markets, as well as South Africa specifically, I'm joined in studio by Jameel Ahmad. He's the Global Head of Currency and Strategy and Market Research at FXTM. Thanks very much for joining us, Jameel, from very far beyond our shores. Thank you very much for joining us. So let's touch on, before we talk broader global macro things, let's talk about the markets today. Why the carnage?
Thank you very much for having me. It's always a pleasure. So we've seen a lot of risk elements that are impacting the market sentiment today, and there's no real individual factor that we could say that's contributing to this move. We've seen a lot of sign in emerging markets, we've seen a lot of sign in Asia, Europe and the United States, and this is something that we're noticing now for the past 2 weeks. We could say that it's concerning comments from the IMF 2 weeks ago in Bali that global growth has probably peaked and it's at risk of plateauing. We know they revised down the global growth forecast for 2018 and 2019. So perhaps this is digested by investors as a sign that this is as good as it gets. But of course, you've got a lot of geopolitical risks that remain ongoing. Saudi Arabia is very much in the headlines, especially after the speech from President Erdogan in Turkey earlier today. Global trade tensions remain as ongoing as they have been for a long time. And then you've got other risks as well, such as stronger dollar, US interest rate policy, and there's a lot of different individual risk elements that are really, I guess, combining together to provide a very negative market sentiment, especially for the emerging markets as well.
Let's touch on the Saudi Arabia issue. To what extent will that particular situation and a possible standoff between Saudi Arabia and the United States, to what extent might that affect the oil market, if at all?
Yeah, that's going to be a big thing for oil because geopolitical risk has always been something that's made oil prices very sensitive. So you had those indications earlier at the beginning of last week that oil could possibly be used as a weapon if there was some geopolitical risk that really escalated. But that seems to have subtracted somewhat. So oil markets have actually been sold since they hit their highs 1 week ago. It's down another 2% today. I think investors are just pretty nervy because geopolitical risk is something that's been very sensitive in the Middle East for some time. Then you've got President Erdogan and Turkey, and obviously all that political risk that's transpired to massive lira weakness over the past 8-9 months, and somewhat even before 2018, sorry. Then you've got President Trump, he's also involved, and then Saudi Arabia. This is very much a diplomatic and political issue, but because of the way that political risk impacts and influences the financial markets now in ways that we've never really seen before, this is why it's attracting investor attention as well, and why it's probably also weighing on sentiment somewhat.
A couple of questions thrown in together. We talk about global economic growth. Is there really global growth, or is just the United States growing? That's the first issue. And then in terms of the US-China face-off around trade, that doesn't seem like it's going to let up, and it looks as though indeed the US will end up levying even higher import tariffs on China come next year. So what will the growth outlook be for China there? Because they can't actually retaliate dollar for dollar, because obviously they export more to the US than the US exports to them.
This is correct, and this trade tensions have been ongoing now for a number of months, and nobody can really see light at the end of the tunnel. Obviously, everybody does hope there's a breakthrough somewhere, and that's not just in the global economy, that'll be from both sides, the United States and China, because there really is no winner from a trade war, and you're looking at the biggest risk for the global economy since probably the financial crisis of 2007, which was, historical. And this is also weighing on the global growth outlooks. That's why emerging markets are very weak. In reference to your first question, when it comes to the developed world, the United States really is on a par of its own because it's printing growth levels that are very impressive at levels that we don't see even in emerging markets in some cases. And then when you've got Fed policy and central bank policy as well, the United States is really, it's on its own, and ECB, Europe, Bank of England, United Kingdom, Bank of Japan and the Japanese economy are not yet anywhere near the level the United States is consistently hitting.
So where do poor old emerging markets like South Africa fit in this increasing world disorder as opposed to order?
Well, emerging markets are very much reliant on investor appetite towards risk, and we're living in very uncertain times, not just in terms of market uncertainty, also in terms of geopolitical and political risk. So automatically this means that investors are less attracted towards taking on risk. They'll have less appetite for riskier assets, and that consequently impacts sentiment towards the emerging markets, which then consequently means less buying attraction for the likes of the South African rand.
But how can emerging markets come out of this bind? It's seemingly a bind. So when everybody's nervous, they go to developed markets. And yet there's still real value, still great growth potential in emerging markets, great population in terms of young people and so on, depending on which economies you look at. How can we get out of that bind and have a bit more rational investment, if you like, where people look specifically at a country, specifically at a sector, rather than just following the herd and saying, right, let's all fly into US treasuries?
It's a very good question. Actually, there's positives when it comes to emerging markets, growing middle classes, growing education, and, a lot of potential. That's something that's not going to go away. Despite a lot of market instability this year, emerging market growth is actually pretty strong, exception of South Africa, which is unfortunately in its own technical recession, but the majority of emerging markets remain very strong. So market instability isn't something that's impacting these economies so what. However, so many different external risks, and until these external risks go away, there's really no way to say or even to indicate that emerging markets can come back into investor demand, just because this market's very unpredictable and investors do not want to take on risk.
There doesn't appear to be plain sailing for the European Union at the moment. On the one hand, you have Italy deciding to do its own thing in terms of drafting a budget. And I heard from our analyst earlier today that apparently the EU has said to Italy, go back to the drawing board and redraft a proper budget. So we wait and see what happens in that regard. Then on the other hand, you have the United Kingdom, which looks like it's in a desperate position and increasingly looks as though it's going to proceed with a hard Brexit. With only 5 months to go before it's scheduled to leave the European Union. So what implications does this have for the euro? And of course, I've seen already that it has been weak amid the negative headlines.
Yeah, these are other risk elements that also remain very much on traders' radar. So you've got Brexit, you've got budgets in Italy. You also had that recent vote in Germany that suggests that populism's getting more strength in Europe. These are big risks for financial markets. They're big risks for both the UK and EU economy. Obviously, the British pound has been historically weak now for 2 years because Brexit remains such a mystery. Nobody really knows what's going on there and whether the UK is ready to leave in just over 4 or 5 months' time. They haven't got long left to make a deal, and they seem to be in deadlock. When it comes to Italy, it is more of a risk than Greece, which obviously took the financial markets by storm back in 2015, 2016. However, it's not something that investors seem to be as worried about as the other uncertain external risks that are really impacting market sentiment.
And so we come to South Africa, Jameel, where we'll be having our midterm budget policy statement being announced tomorrow. What about the speech will either appreciate or depreciate the rand?
It's difficult to say what kind of impact it will have on the South African rand, because if you look at the markets today, global markets are sullen all over the place, which means there's already negative pressure on the South African rand. And actually, I'm surprised that the South African rand's only weakened about 0.4, 0.6% as we speak now. Generally, with a financial market sell-off as heavy as it has been, you're looking at weakness at least above 1%. In terms of what the budget statement and what investors will look for, they'll probably look for some sort of projections on economic growth when where the policymakers really think the economy can exit the recession, what kind of economic stimulus they can provide the economy. However, if we have a very negative day in global stock markets, we shouldn't expect too much from the budget. It might not even have that much of a medium and longer term impact on the South African rand.
Since you're the head of the currency desk, I'll ask you the question, even though you've pretty much mentioned that it's quite difficult to call, but what sort of trajectory do you see for the rand towards the end of the year, beginning of the year?
Yeah, these external risks aren't going away, and until they go away, the overall bias will be on a weaker front, and that we're probably going to see more currency pressure in the emerging markets because these are long-standing issues that simply remain current. If you wanted to come back in the South African rand, you would look for a breakthrough in United States and China trade tensions, or you would look for President Trump to become even more outspoken about dollar strength or US interest rate policy, which would then encourage investors to sell the dollar. Dollar strength is still very current in the global markets, which is why emerging markets are under pressure.
All right, Jameel, thank you very much for that very interesting update. That was Jameel Ahmad. He's the Global Head of Currency and Strategy and Market Research at FXTM.